All right, well, Hugh Hendry is our guest host this morning. Hugh is CIO and partner at Eclectica. Good morning, Hugh.
Good morning, Joe.
You've come with a tie.
No one told me it was dressed down Friday.
I am touched. This must be the first time. Does this tell us just how grim things are over at Eclectica in terms of redemptions from investors? I mean, we know you're up, but are they taking their money away?
They're taking money away from everyone. That's not why I'm wearing a tie. Seeing one of my very important Italian clients today, and they always insist that I dress like an adult, not like a teenager. But hey, there's redemptions everywhere. Yeah, we certainly haven't been spared that. Our hedge fund, top 1% of all hedge funds in the world, we're up over 30% this year. Our long-only business, I manage a European long-only mutual fund. We're down about 13% on the year, so we're about 23, 24 points ahead of the index. You can't get any business. And I tell you, Jeff, I'm good. I'm a good manager. I've made a lot of money. I made a lot of money when people were losing money. I don't make money when people are making it, so I'm kind of contra-cyclical, and that's kind of special. People won't touch me. They won't. I'm deemed to be a scary kind of investor. They won't touch me. So maybe I should wear a tie.
Let's just adjust this microphone here, because I think the novelty of seeing you in a tie has overwhelmed the technicians.
Overwhelmed the system.
Yeah, and I think you've got your foot on the cable, so let's just sort this one out.
This doesn't happen in America.
No, strange that, isn't it? The curious thing is, I mean, people have run to cash, or they've run to cash equivalents, and we saw that obviously in the 3-month bill yesterday, you know, when we've ultimately gone negative here. What is it going to take to embolden these holders of capital to finally come out and start putting some of it back to work? Does the economic data have to start turning around? What signals do they need to see? I mean, we've seen all of this price action in the last 2.5 weeks that has driven equities higher on significantly lower volumes than we'd normally see at this time of year. It strikes me we've come to a point already where nobody wants to take an active position to the year close now. We're sort of done as far as the market's concerned. But the bigger picture of what signals will be needed to get people to recommit capital.
Yeah, well, you're quite right. I mean, the financial year ends for most operators, investment banks and hedge funds, really around Thanksgiving. Yeah, so with regard to my hedge fund, I'm closed for the year. I'm off on holiday next week. Merry Christmas. Yeah. Now, with regard to engaging or re-engaging in risk-taking, I think rationally we're a long way off. Okay, what's going on in the stock market in the last 2 or 3 weeks doesn't have any information. It's not telling you anything. Yeah, there's no sudden re-emergence of risk taking because the volume's not there. And what we're seeing is we have to recognise that in a world where the volatility of the stock market is as high as it is today, so the VIX measure is between 60 and 80 depending on the day you gauge it. The S&P could easily be above 1,000. Yeah, it could be 1,100. It could be at an upside level for 3 or 4 months. But likewise, if it could be there, it could be at 600, right? So it's a bit like the Clint Eastwood movie, you know, Dirty Harry, whatever. You know, with is the revolver loaded? How lucky do you feel? Is it 1,000 on the S&P or is it 600? Go on, punk! I dare you. Press the trigger. Now, clearly, that's not a rational decision that anyone wants to take just now, and everyone's shying away. If only they were all in cash. People still have risk. People still are deleveraging. People are locked into underperforming funds, and that will continue. I'm, as you know, very fearful for all of our futures.
Larry writes in and asks, you know, whether you feel conflicted in any way, talking about worldwide depression at the same time as you're up on government bonds and maintaining that position. Do you look as though you're a fund manager who is talking your book effectively?
Everybody talks their book. You've no idea the aggro I get for coming on shows. You know, clients say, "Why do you do it?" I get emails saying that I'm arrogant, that I'm conceited, that I'm ugly, unpleasant, you name it. Yeah, I do it because I'm passionate. Yeah, I do it because 99.9% of people like me come on and they talk rubbish. Yeah, they're incentivized to tell you that the stock market goes up forever. Remember that nonsense? They were bullish in 2006. They were bullish in 2007. They were bullish January, February, March, April. And heck, they're still bullish today. Strategists, they're all rubbish, Jeff. But they're all incentivized to be pervasive bulls, right? I hope if there's any integrity in this world, or my world, my integrity is I try and tell you the truth. Yeah? And the truth is, be fearful. And if you're fearful, you might not have lost as much money this year. Your pension fund might not have halved this year. Yeah. So that my pension fund hasn't lost. My pension fund's up.
Yeah. Isn't it a truth, though, that if you invest in government bonds for full year 2009, you're effectively making a non-investment decision? I mean, the return that you're going to get with yields where they are today is so low that you might as well not bother engaging.
Okay, yeah, no. I think we can re-paraphrase it somewhat, but I think you're quite right. I've made money in conventional government bonds, and it's accelerated, especially in October and November. Government bonds today, conventional bonds, are expensive, right? The US 10-year bond yield last week hit 2.55, a 50-year low, and its lowest ever level was 2.3 in around October 1953-54. Now, let's say we go to 2, right? 2% yield. That would be the lowest yield ever. You would only make about 4% owning government bonds. So, Jesus, you know, you only make 4, and yet you're looking for an extreme. So they're getting to the overvalued level. But don't forget, in bubbles, you get these very, very stretched, overvalued levels, and I think we're in the realms of a bubble in conventional bonds. But later on, what we'll go on to discuss is there is an opportunity in index-linked, or an opportunity is emerging in the TIPS markets. It's wiped out everyone. It's wiped out all the gold. All the gold bulls are the same guys who bought the inflation-linked securities, and the inflation-linked securities have wiped them out this year. I don't like buying things which are falling, but in the macro world, there's a price for everything. And I want to tell you later on about the 2-year US security, which yields 6% real, and it's beginning to look a little bit tantalizing.
That's a very tempting cast of the rod. We will pick up with that conversation with Hugh Hendry this morning.